this example video, we're going to look at review exercises 13, 11, 12, and 13. So it tells us that on January 1st, the company purchased 300 shares of Cornet Company common stock at $40 per share, and they want us to prepare the journal entry to record the purchase of these equity securities. So when we're talking about equity securities, that means we're buying shares of stock in another business, so different than when we're the bond holder. So our investment in our equity securities is going to increase by how much we've paid for it. So they told us we've paid $12,000, and we are going to credit our cash for that $12,000. In review exercise 13-12, it says that assume on December 31st, the investment in Cornet Company stock has a market value of $10,500, and they want us to prepare the year-end journal entry to record an unrealized gain or loss. So on December 31st, when we're talking about equity securities, the treatment is very similar, kind of mirrors how we record things for under the trading securities method. So we're going to directly impact that investment account for any increase or decrease in the fair value of those investments. In this case, our fair value is actually lower. So our fair value is only at $10,500. So we have an unrealized holding gain or loss, in this case a loss, on our equity securities. That's why it's debited. And we're going to directly impact that investment in equity securities account. We're going to reduce it. We're going to bring it down to its fair value. So $12,000 is what we recorded at initially. Its fair value as of our balance sheet date is $10,500. So we're going to reduce our investment account of $1,500, and we're going to record that unrealized loss, in this case, of $1,500. And then it says assume that on February 1st, they sold the investments for $10,000. So on February 1st, what we are getting is cash of $10,000. We need to compare the cash that we're receiving to the carrying value of that investment. So our investment went on our books at $12,000. We reduced it by $1,500 at December 31st to bring it down to its fair value, meaning that our investment account is showing a value of $10,500, and we're only getting $10,000 for it. So that means we are going to have an actual loss on the sale of our equity securities of $500. And then we actually have to remove our investment in equity securities for the total $10,500.